Good morning, everyone. Just a minute, I'll just confirm that I'm live. Good morning, everyone. All right, friends. Okay. Fine, sir. Fine, everyone. Let's start off with the next session. Before I start with the next session, let me just quickly give you the overview of what are the concepts that we learned today morning. I'll quickly call it as a concept revision. All right. In this concept revision morning, we learned first concept. What we learned was NPV. Then we learned what is cash flow. Then we learned what is discount factor. Then we learned the relationship between discount factor and IRR. After that, we went to the chapter of, or then we learned the concept of how to value an asset. After that, we went to the chapter of bond valuation. In this chapter of bond valuation, we learned how to value a bond. After this, we learned about yield, and we learned that there are basically 5 types of yield. First one we learned is current yield, bond equivalent yield, effective annual return, yield to maturity. We learned 2 types without considering time value of money, after considering time value of money. All right. Okay. So let's just quickly understand this, friends. First thing I started off with NPV. NPV is nothing but present value of cash inflow minus present value of cash outflow. After that, we went to the next concept, which was cash flow. The formula for cash flow, what I mentioned, is profit after tax plus depreciation minus capex minus additional working capital. After this, the next thing that we learned over here is that, okay, the left side of the screen is not fully visible. I will make sure I don't write on the left side. All right, just give me a minute. One minute, friends. Let me just try correcting that a little bit here. Okay. Now the left side will be visible to all of you, friends. Okay. All right. Just a minute. All right, friends. Now you can view the whole screen clearly. I hope so. All right. So friends, we learned about discount factor. Discount factor is nothing but investors' expectation. So if me as an investor, what are my expectation is what will come over here. So basically I will have, let us say, 3 options. Option number 1, put the money in bank. Option number 2, put the money in father's business. And option number 3 will be put the money in, let's say in my earlier example, it was, let us say, Belpuri business. Am I right? Okay. So once we learned that, we understood that discount factor is investors' expectation. In the long run, whatever is the investor's expectation, the price of the share will move in such a way that NPV should become 0, and that will be the point at which it will turn out to be the IRR. So in the long run, discount factor and IRR will remain the same. After that, we learned the next important concept, which was how to value an asset. Please cover Forex concept is a feedback. I'm covering that. Day number 3 is Forex. All right. So how to value an asset? Value of any asset is nothing but present value of future cash flow that the asset can generate. This is the most important concept. Value of Salman Khan is also present value of future cash flows that his movies can generate. Or value of WhatsApp is nothing but the present value of future users who are going to use WhatsApp. In other words, value of any asset is nothing but the present value of future cash flows that the asset can generate. Now, bond is exactly similar to debentures. The only difference is that debentures are issued by private organizations, whereas bond is issued by government corporations. All right. Then we learned yield. Yield is nothing but bondholders' expectation. Value of a bond is nothing but present value of future cash flow which the bond can generate. Bond will generate 2 types of future cash flows. One is the coupon payment and the other one is the redemption value. All right. Once you learn this, we learned 5 types of yield. I will quickly draw a chart so that that part can be clear to you. First, we learnt about current yield, for which the formula is coupon amount divided by current market price. Then we learnt about bond equivalent yield, which is nothing but discount amount divided by current market price. Third, we learnt about effective annual return, which is nothing but 1 plus y whole power n minus 1. Here y is nothing but bond equivalent yield. Then we learnt about yield to maturity. We learned it in two manners. One was without considering time value of money, and the other one is after considering time value of money. Alright, this one was nothing but coupon amount plus redemption value minus issue price divided by life whole divided by redemption value plus issue price divided by 2. This is nothing but the actual IRR. Alright, so according to me, this is the best formula, but exam point of view, we normally use this formula, or we use this formula, or we use this formula. This and this, unless they specifically ask, you don't have to use this in the examination. Alright, fine friends. So I hope everybody is clear with the concepts so far. Right. If you're clear so far, let us now start cracking one of the questions on this. Even before we go to crack a proper problem, I will give you a pattern in which we should solve a question. So let's give a heading in your books. How to crack problems in exam. This is important. Just give a heading like this in your books now. Fine friends, now I will share with you an important tip as to how we are going to crack problems in the examination. Friends, in SFM exam, every question, whichever question comes, you follow this pattern. 99% cases you will get the right answer. You will not have to do anything else. So the best thing about this class would be the way you approach the question. If you can crack the question properly, one thing is for sure, you can easily get the answers also. Am I right? So friends, the pattern, or there's a very important message that I would like to share with you. I'll first put the whole steps involved over here. When you go to the exam hall, always you should start with working note 1, basic data. What you have to do here is you have to copy all the numbers what you see over here in your books. So in a question, if you see some numbers, copy those numbers directly to your books. That is called basic data. Working note number 2 should normally be analysis. Here you should find out the hidden info. I will explain to you what that means. After this, so this is what I will call it as step number 2. Step number 3 will be, once you do these two things, we should apply the concept which I am teaching you. And finally, we will go to step number 4, which will be the conclusion. Alright. First, write down these 4 steps. Then I will explain the meaning of these 4 steps one by one. Can you please write down this in your books? Alright friends, now I will explain to you what this actually means. Okay, friends, we should always start with basic data. The main purpose of basic data is not for you to get marks in the exam. The main purpose of basic data is so that you can understand the question. Friends, only if you understand the question, you can get the correct answer. So I have a very strong theory. If you understand the question, you should get the right answer. And the best way to understand the question is by writing working note 1 basic data. Because when you write down basic data, all that you're doing is reading the question and making short notes in your exam answer paper. And you know very well, if you read something, you won't understand fully. But when you read and you write down, your brain takes the data very clearly. And once you understand the question thoroughly, trust me, getting the answers will become extremely easy. All right. After you do basic data, we will go to working note number 2, which is called as analysis. Analysis is basically a part where we will try to find out the hidden information. All right. For example, if in the question they have given the number of shares is given as, let us say, 100, and they have given the price per share is 10 rupees. The moment you see 100 shares in 10 rupee, your brain should tell you that the total market value of this company is turning out to be 1000. This is a data which is there in the question, but which is hidden inside the question. So what you have to do is pull out this hidden information. That is step number 2. So friends, I repeat, step number 1, write down the basic data, because that is only done for one purpose, that you should understand the question thoroughly. Then the chances of you getting the right answer goes up very, very high. Step number 2 will be analysis, where you will try pulling out the hidden information. And after this, once this data is available, then you have to apply the concept what I taught you, and finally we go for conclusion. All right friends, I hope you are clear with these 4 steps that I have mentioned over here. Keeping this, shall we start cracking a proper problem now? All right, everyone take a look at the board now. This is question number 1. Friends, my handout will be available in my website by today evening. Tomorrow morning you can download it yourself. I'll show you how to download it. You just have to go to the website, click on download, and you'll get the entire PDF file. I was just working through the material and now it's ready. By evening you will definitely get that. All right. Now friends, first point, as I told you, read and understand the question. I'll give you 5 minutes time, after which we will solve this together. Anju, you are saying that should we leave space for the final answer? My opinion is don't leave any space for the final answer. Whatever is the final answer, give it as conclusion. If you start with the final answer is a problem. If you start with conclude, if you put it in the end, you never have to leave any space. Secondly, the valuer, once he goes through your paper, first question he will read, he will understand how you solve it. So what he will do is that by the time you reach to the end and you give a conclusion, remaining questions he will definitely search the end part only to get the final answer. For you also easy, for him also easy. All right. All right, friends. Now, as I said, let us start cracking this question. We should ideally start with working note 1, basic data. Friends, this question, entire data is given in table. You don't have to be extra hardworking. That you see the table, copy paste the whole table, not required. Our objective of basic data is to understand the question in a proper manner. So in the exam, if a table is given, you don't have to copy down the table. You can directly go skip working note 1, basic data, and you can directly go to working note number 2, analysis. Are you clear with that? Let us read and understand this question together now. Friends, in this question, they have basically given 4 scenarios. 0 coupon bond, treasury bill is given, 10.71% GOI bond is given, 10% GOI 2018 is also given over here. Let us read the requirements one by one. Please go through the first requirement. If the video is lagging, I'll just hold on for a minute. Alright, I think the video is at par now. Okay, so we are now reading through the first requirement. If a 10-year yield is 7.5%, what price the 0 coupon bond will fetch on 31st? 1 minute, it's not clear. What is exactly not clear? Are you not clear with the question? Can you please chat and let me know? I will repeat the question. I'm just reading the requirement. We have not yet started solving it. Okay. If a 10-year yield is 7.5 percentage, what price? So the requirement is what price the zero coupon bond will fetch. So the question over here is what will be the price of a zero coupon bond? So I'll write down over here working note number 1, price of a zero coupon bond. All right. Just so that you understand the question better, what I will do is I will write down Roman number 1, basic data over here and copy the details inside, after which we will solve this one by one together. All right. Let us read through the question again now. They have given the face value as 10,000. So the face value is equal to 10,000. All right. After this face value is given as 10,000, they have given the maturity date is equal to 31/3/2023. Am I right? Yes. They have not given any coupon rate because this is a zero coupon bond, and zero coupon bond will not be having any coupon amount coming over there. So friends, I can find out the life of the bond from this data which is given over here. That is, the starting date is given as 31st March 2013, right? And the subsequent date is 31st March 2023. So it will be, life will be 10 years. Bracket we can write down 31/3/2013 to 31/3/2023. Okay. We have got the life also over here. After that, they have given the yield is 7.5 percentage. Yield is equal to 7.5 percentage. From this, they are asking us to find out the price of the bond. Okay. Can you please write down this in your books neatly now? Have got the life also over here. After that, friends, is the video clear? Somehow I'm not able to see the video clearly. 7.5%. From this, they are asking us to find out the price of the. Let me try from a different phone. Yes, Dimple, I'll be sharing the questions file also. Wait, I think the video is not clear. Let me just cross check once again. It is clear. I think in my other phone it was not clear, so I got a bit confused. It is clear. All right. Okay. All right. Fine. So have you written down so much in your books? So they are basically given the face value, maturity date. They have given the life of the bond, and they have given the yield. Am I right? Now they are asking you to find out. Now they are trying to find out the price of the bond. Okay. So I will write down Roman number 2. Price of the bond. Friends, we have already learned that value of a bond is nothing but present value of future cash flows that the bond can generate. So I'll write down below this. Value of a bond is the present value of future cash flows which the bond can generate. All right. So to get this future cash flow, what we have to do, we will draw a table. Here, cash flow, discount factor, discounted cash flow. Here I am going to get at the end of the 10th year. What is the money that I will be getting at the end of the 10th year? I will be getting the face value of 10,000 rupees only. Am I right? and my yield is turning out to be how much percentage? 7.5 percentage. From this, I am supposed to find out the present value. Let's calculate the present value together now. It will be 0.4851. So when I do 10,000 into 0.4851, I will get the answer as 4851 rupees. Therefore, value of zero coupon bond will be 4,851 rupees. Alright friends, can you write down till here in your books now? Manikam Gopinath, this is a question number 46 in the practice manual. I'm not pretty sure what's the question number, but we are doing only past examination questions, or we are doing the practice manual question only. Yes, the answer is 4850. It can be 4851, 4852. Rounding off is absolutely fine. Once you're done, please chat and let me know that you are done. Okay, Sandhya Vishwanath, you have asked a doubt. What about the coupon payments? It's a zero coupon bond. There will not be any coupon payments at all. Alright? Okay, so everybody is done. I'm getting a good chat reply now. So I'm very comfortable with this. Okay, let's go to the next one now. Okay. The next part is second one, that is Treasury bill. So they are given the details of Treasury bill, that is 1 lakh is the face value, 20th June is the maturity date, etc. And once we come down, they are asking what is the annualized yield if the T-bill is traded at 98,500. I think somebody has asked this question earlier. Annualized yield is normally a term used in mutual funds. But here also they have used in this question. This is nothing but bond equivalent yield. So you can note down a point in your books, friends, that annualized yield and bond equivalent yield are one and the same. Can you please write down this note in your book somewhere? Alright friends. So once you have put up till here, they are asking you to find out the annualized yield. So I'll write down working note number 2, annualized yield for T-bill. Inside this, I will write down Roman number 1. Okay, I'll write down basic data. So we can copy down all the numbers over here properly. Okay, inside this, I'll write down point number A. Treasury bill, the face value is 1 lakh. Point number B, they have given the maturity date also over there. The maturity date is 20th June 2013. In this case, we can find out the duration also. April, it will be 30 days. May, 31 days. June, 20 days. So I'll get the answer as 81 days will be the duration of this bond. Alright. From this, point number D, have they provided any other details? They have given the current market price. Okay. What is the current market price which is given over here? Is it given as 98,500? Yes. From this, they are asking us to find out the bond equivalent yield. Okay. Can you please write down this basic data in your books now? Fine, friends. Ruchi, I think your answer is right. I need to cross check that. Good speed. All right. Once you write down all this in your books, I will go to the next page. Yeah. Okay. I'm going to the next page. Roman number 2, I will write down bond equivalent yield. So we know the formula. Always you should write down the formula to score marks. That is equal to discount amount divided by current market price into 365 divided by actual number of days. Okay. So here the discount amount would be 1 lakh minus 98,500 divided by 98,500 into 365 divided by how many days are there? 81 days, right? That would be 1,500 divided by 98,500 into 365 divided by 81. I'll get the answer as 6.86%. Yes, I think this was the same answer that Ruchi also got earlier. Yeah, excellent. Good work. Yes, Jayashree, 6.86% is the answer. Let everyone write down and finish it off. Sajuddin, you don't get marks for basic data, but if you don't write basic data, your understanding will come down, and analysis part you might make mistakes and you lose marks there. So basic data is not to score marks, but it is for helping you to get marks in the remaining working notes. Alright friends, okay. I hope everybody is clear with this part of the part. Can I go to the next requirement now? Okay. Now this is the next requirement. Everyone read through the next requirement. If 10.71% bond is having a yield of 8%, what price will it fetch? So now we come to the third bond. I'll write down the next working note heading. Working note number 3. Price of 10.71% bond. Alright. Now as I always do, I will write down inside this Roman number 1 basic data to understand the question properly. Okay. Inside this I'll write down point number A. What is the face value told over here? Face value is 100. Okay. Point number B, the maturity date is given as how much? 31/3/2023. Alright. Then they have given the coupon rate as how much? 10.71%. Then they have given that the payment is going to be made every yearly and the yield is 8%. Point number E would be frequency and the frequency would be yearly. Alright. Once I put all these details, I can also find out the life. The life of the bond will turn out to be 10 years. 31/3/2023. From this, they are asking for only one thing. What should be the price of the bond? That is the question. Alright. I'll give you a minute. Can you please write down till here in your books now? Alright friends, if you are done with this, I will now go to the next point, Roman number 2. Here I will write down price of the bond. Everyone once again interact with me. How do you value any asset? Value of any asset is the present value of future cash flows that the asset can generate. Similarly, value of a bond is also nothing but the present value of future cash flows that the bond can generate. So here I'll draw a table. Here, cash flow, discount factor, discounted cash flow. Alright? Okay. Here I will be using year 1 to 10. 10.71 will come. At the end of year 10, 100 is going to come. Am I right? Yes, that's right. After I do this, then I will use the discount factor of how much is told over here? 8%. So for 10 years, it will be 1 divided by 1.08. I'll have to press equal to 10 times. So I'll write here first 0.463, then I'll press GT. I'll get 6.71 over here. So this into 10.71 would give me the answer as 71.86, and here it will be 46.3. So the total would be 71.86 plus 46.3. 118.16 should be the answer. Excellent. Many have already got the answer on your own. Great work. Can you please write down others and finish it off till here? Okay, Sajuddin, you have a very good doubt. Price here is for decision making purpose, or it is the actual price? Friends, actual price I can never find out using a formula. Let's understand that, friends. If you go to a share market, whatever is the price, I can't do a table like this and I can tell this is the price. Then I will become God. All the price that we find out using formula is theoretical price. So this 118.16 is only a theoretical price. Or I would say in a different word, this should be the price. Alright. This I should compare with the actual price. Suppose the actual price is turning out to be 120. It means right now the price is 120. The price should be 118. So right now the price is overvalued, and because it is overvalued, we are supposed to sell. And suppose the price was only 115. The price should be 118 means very soon the price is going to go up to 118. Hence it is undervalued today, and therefore we are supposed to buy. That is the concept over here. I hope you are clear with this part also. If you want, you can make a short note of this for your understanding purpose. One more good doubt is coming, decimals. Exam point of view, friends, keep this one rule in mind. If the question is giving in 2 decimals, you can solve in 2 decimals. Question is giving 5 decimals, solve in 5 decimals. Question does not give any decimals at all. You do it in 2 decimals is more than enough. You really don't have to strain so much. And trust me, people don't lose marks because of decimals. People lose marks because they go wrong conceptually. So there are 2 types of mistakes. One is called as a conceptual error and the other one is called as the arithmetic error. Maybe you should understand this also. Conceptual error, and the second one is arithmetic error. Arithmetic error is, for example, you have done a mistake in the calculation. For example, you put 4 into 2, instead of writing 8, you wrote 6. So this conceptually you are right, but arithmetically you are wrong. For this, normally the institute cuts half mark only. Conceptually, instead of putting 4 into 2, if you end up putting 5 into 2, you are conceptually wrong, you will get 0 marks over here. That is the difference between a conceptual error and an arithmetic error. Alright. I hope you are all clear with this part, friends. If you are clear with this part, can I go to the next part of the question now? Alright. Now we go to the final requirement, friends. Everyone please read through the final requirement. If 10% bond having a yield to maturity is 8%, what price would it fetch? So now we are coming to the final bond, that is this bond. So I'll write down the next working note number 4. Value of 10% GOI 2018. Okay. Roman number 1 would be now basic data. Okay. In this I'll write down point number A. Point number A would be the face value. The face value is turning out to be how much? 100. Point number B, the maturity is coming as 31/3/2018. This means the life over here turns out to be 5 years. Alright. The next point what is mentioned over here is that coupon rate is given as how much percentage? Coupon rate is given as 10%, and they have given that the frequency of payment over here will not be yearly, it is going to be half yearly. They have also given the yield, I assume. The yield is given as 8% for the last case also. From this they are asking you to find out what shall be the price of the bond. This is the question what they are asking. Can you please write down this basic data in your books, friends? Alright friends, if you have put up till here in your books, let me now go and solve this problem. Again we will come to the same concept. Price of the bond is nothing but present value of future cash flows. But friends, here we have a twist. The twist is, what is the frequency of the payment? Is it a yearly payment or is it a half yearly payment? It is a half yearly payment. So what will happen is, instead of me paying a coupon of 10 rupee every year, I will now be paying a coupon of 5 rupee every 6 months. I'll show you how that works now. I'll take a fresh page. Roman number 2, value of 10% GOI bond. I will draw the table now, but instead of calling it as year, I will call it as period, cash flow, discount factor, discounted cash flow. Alright. Period, it will be 1 to 10 period, because there are 5 years, so there will be 10 half years. Coupon payment will not be 10, it will turn out to be 5. Discount rate will not be 8%, it will be 4%, because yield is 8 for 1 year, and at the end of year 10 I will get 100. The area that I have put in red is the important area. Mark that area as important. So the discount factor would now be 0.675, 8.11. 1 minute, let me confirm. Yes, so now it will be 5 into 8.11 will give me 40.55, and here I'll get the answer as 67.5. So my total would be 108.05. Excellent, Sai Reddy, you've got the answer very quick. Kiran Jain, extremely good. Keep it up. AJ, good job. That is the right answer. I'll give you a minute. Let everyone finish this. Good job, Kavita. Good job, Shubham. Keep up the good speed. Good job. Alright friends, now once we are done with this, basic data here was not required, we put it in the requirement wise. Analysis is where we found all the 4 answers. Now we have also applied the concept. Now I give a final heading called as conclusion. Alright, point number A, I'll now put it one by one. Value of 0 coupon bond. In bracket I will write down working note number 1. I'll go back to working note number 1 now. I got the answer as 4851. Okay. Point number B, I will write down annualized yield of treasury bill. Annualized yield of T-bill. What was the answer that I got over there? 6.86%. Bracket I will write down working note number 2. Point number C will be value of 10.71% bond. This I got the answer as 118.16. Bracket I will write down working note number 3. Point number D I will write down value of 10% bond. That was the last one. 108.05. Working note number 4. Like this we conclude the answer. Can you please write down with this in your books? So what if we are using 5 year with a cash flow of rupees 10 and 8%? Gauri Shankar, that answer is what we did in requirement number 3. Requirement 4, it's very clear the cash flows are happening half yearly. So friends, if the cash flows are happening half yearly, obviously what it means is that if you have half yearly cash flow means definitely you will have 10 periods. We have to consider the time value of money also. Yes, rates are always given on a per annum basis. We have to convert that into a half yearly part. Yeah, that's a valid doubt. Okay. Once you're done writing, please chat and let me know that you're done. Alright friends, I hope you're all done with this. Now I will just explain to you how we solved it. We wrote the basic data, we did the analysis, we did the conclusion. Now think of me as a valuer. I am correcting your paper. First question I saw, working note 1 basic data. I understand you're copying the whole thing. But from a valuer point of view, normally what I do is I check the question in the question paper, then I look at the answer in the answer paper. It is double work for me. But your answer sheet, working note 1 basic data contains all the crux of the information. Analysis contains all the hidden information. Conclusion contains all the final solution along with the working note reference. So if for example I have a doubt that working note 2 the answer is wrong, I only have to go to working note 2 and check the answer. So as a valuer, if since I'm correcting around 1000 papers etc, I get frustrated. That's when your paper comes in my hand. From the second question onwards, psychologically, what I start doing is, I will not read through the basic data, I will not go through the analysis, I will directly go to the conclusion. I see the answer is there, I will check the working note reference given in the bracket, I will do a backward working and I will read it. That way, you will save at least 5 minutes per question that the valuer as me is solving. I will really respect this kind of presentation and I will feel very positive reading your paper. So definitely I will have an inclination of giving you more marks compared to the previous person because I'll find your presentation better than the previous one. So this is how we score better marks in the exam, by focusing on the presentation. Friends, presentation is the most important thing as far as scoring marks is concerned. It is like you having a 1 glass of orange juice from a roadside shop and having the same orange juice from a 7-star restaurant. The same juice will be delivered in 2 different styles and they will charge 2 different prices. Understand that. Alright. We have to write the units, Priyanka. Your doubt is that we have to write the units. Here all the units is turning out to be rupees. Am I right? So we have to mention rupees. But normally rupees is assumed. Understood? So you really don't have to write rupees. Anything else coming up like units, kg, etc. we have to mention. Alright. Yes, we have to write rupees. I hope you are all clear with this part of the question also, friends. So with this, we are done with question number 1, which covers the bond equivalent yield and which covers the remaining concepts of how to do bond valuation for zero coupon bond, for a normal bond, and a bond for which we are having half yearly payments. Okay friends, let's take a 1 minute cool off. We will now go to the next concept again. Okay, and after the next concept, we will crack the next question. Write down the next concept heading. Average duration of a bond. This is a little complex concept. Please write down this concept in your books. Alright friends, I will now give you a very simple example for explaining this part to you friends. Okay, now everyone look over here. Suppose the coupon rate given by a bond is 10%. Alright. Point number B, the yield is 20% and the life of this bond is turning out to be 5 years. Okay. I repeat, the coupon rate is 10%, yield is 20%, and the life of the bond is turning out to be 5 years. So friends, this means 10% is the amount which bond is giving me. Am I right? Whereas 20% is what my father is giving me. Okay. Now tell me, if I have 100 rupee, I put in the bond, I'll get 10 rupee. I put the same 100 in my father's business, I get 20. Where will I put my money? Will I put my money in my father's business or will I put my money in the bond? Okay. I will put my money in the bond. Alright, sorry, not in the bond, in the father's business, because he is giving me more return than what I will be getting. Alright. Now, if I want to argue in a different way, I can argue like this. Listen very carefully. Whatever money I get in the bond in 5 years, I repeat, whatever money I get in the bond in 5 years, the same money I can get in my father's business in, your mind will tell you the answer as 2.5 years. Friends, 2.5 is an approximate answer because you are ignoring time value of money. But ideally speaking, the answer should be less than 5 years. This answer is what we call it as average duration. I will write down over here. I'll write down this way. Whatever, this is the logic, okay? Whatever return I get in the bond in 5 years, the same money I can make in my father's business in, I will call it as less than 5 years. Precise answer I will show you later. This answer, if you say the answer is 2.5 years or 2.6 or whatever answer you are trying to say, that answer is what we call it as average duration. Can you please write down this in your books now? Sajuddin, yield and coupon need not be same. Yield is the expectation. Coupon is the return what the bond is giving me. Yes, random stuff. I don't know what exactly is your name. You will be getting a handout by tomorrow. I have explained this earlier. I'm repeating it once again. Tomorrow morning you'll be able to download the handout yourself. I'll show you how to do that. All right. All right, friends. I hope you have written the logic of average duration. But the best way to understand average duration is by cracking a problem. Average duration can be solved using two methods. Average duration, this can be solved using two methods. Alright. First method is what I call it as the table method. Okay. And the second method is what I call it as the formula method. Right now I'll just give you the format. Proper understanding you will get only once we crack a problem. Alright. Here the table format would be year, cash flow, discount factor, discounted factor, weight into duration. This is going to be the table format. How I will show you in the next question. It's very difficult to explain without numbers. Alright. Formula, the formula would be average duration is equal to 1 plus y divided by y minus 1 plus y plus n into c minus y divided by c into 1 plus y whole power n minus 1 plus y. Beautiful formula, friends. I think I have not written it very neatly. You copy down till here. I'll write down again in a fresh page. Yes, George, when the bond is selling at par, yield and coupon rate will be the same. What you said is right. Alright friends, I will write down the formula once again neatly so that you don't miss it out. Okay, I'll write down over here 1 plus y divided by y minus 1 plus y plus n into c minus y divided by c into 1 plus y whole power n minus 1 plus y. Okay. Now tell me friends, is this formula easy or tough? Friends, whenever you come across this formula, many of you have already thought in your mind, skip this. Let me just share with you one small tip over here. Friends, there is nothing in this world which is tough. Whenever you come across a word called as tough, you should replace this word with another word which is easy with practice. Our brain is so powerful that we actually have got two layers of mind. One is called as the conscious mind and the other one is called as the subconscious mind. The problem is we forget only those things which stays in the subconscious mind. Once something goes in your subconscious mind, then even if you want to forget, you cannot forget it. There are many methodologies through which you can tap the power of your subconscious mind, but one of the best methods which has been used since ages for making things go inside your mind is called as the power of repetition. So if you repeat the same thing again and again and again, it goes deep down your subconscious mind, after which even if you want to forget, you cannot forget. My only request to all of you is, friends, today after the class gets over, you have to invest 5 minutes of your life. That's all. In this 5 minutes, if you say 60 seconds, we are talking about 300 seconds. To write down this formula one time, it might have taken you around 20 seconds, which means you can write down this formula approximately 15 times. If you write down this one formula 15 times today evening, from tomorrow, even if you want to forget, you cannot forget. And in exam, once the question came in such a way that the only way that you can solve it is using the formula method, you couldn't solve it using the table method. I hope you have written down this formula in your books now, friends. Alright. Once you have written down this, shall I now go and start cracking a problem on this one, friends? So along with the problem, I will explain the logic of average duration once again with both the methods, that is the table method and the formula method also. Alright friends, now let us do one thing. Let us now go to the next question, question number 2. This is the question. I'll give you a minute's time, friends. Can you please read through the question and understand the question? After this, we will practically solve this question together. Srinivas, practically yield is investors' expectation. My expectation keeps on changing. Today if I expect 10, tomorrow I might expect 12%. So practically, yes, yield keeps on changing. Read and understand the question, after which we'll write down the basic data together and we'll solve the whole problem together. Good to know that, Abhilash. And I hope you remember the formula even now. Excellent. Fine, friends. Shall we start writing the basic working note 1 basic data together now? All right. Take a fresh page. Question number 2. Working note 1 basic data. All right. Let's do it one by one. Okay. X Limited has made an issue of 14% non-convertible debentures on 1/1/2007. So friends, first thing, it is a debenture based question. So I'll write down interest on debenture. Coupon is a word used only for bonds. This turns out to be 14%. Then the issue date is told to be 1/1/2007. Point number B, issue date 1/1/2007. All right. These debentures are having a face value of rupees 100. Face value is equal to 100. And they have told they are currently trading at a market price of 90. Sai Reddy, you have got the right answer. Okay. So here it will be current market price. That is equal to 90 rupees. Down they have used a beautiful sentence. Interest on this will be paid through post-dated checks. Interest for the first 3 years will be paid in advance through post-dated checks, while for the last 2 years, post-dated checks will be issued at the end of the 3rd year. Friends, this whole sentence is given just to confuse you. First thing, they are saying interest will be paid in advance by way of PDC, means there is no time gap. PDC will be only presented later. So I give you a check now, I tell you pay it on expiry date or correct maturity date. What is the problem in that? So this is a sentence only to create confusion. Ignore it. Down they have told the bond is redeemable at par on December 31, 2011. So redemption value at par means it will be redeemed at what price? 100 rupees. Alright. And they have told the life to be how many years? 5 years. Can you please write down the basic data in your books now? Excellent, Shubham. You all have got the first answer. Kiran Jain, you are very quick. You have got the answer for the second one also. Sri Lakshmi Nayak, 15.55 is the right answer. I'll go a bit slow. Let everyone be at par with me. Okay. Yes, 16.84 is right, Ruchi Jain. Okay, I'll now start solving it. I will now write down working note number 2 and start cracking the first requirement one by one. Okay. The first requirement is current yield. So we already know the formula for current yield. Current yield is equal to coupon amount divided by current market price. Okay, so the coupon amount in this case is turning out to be, we have the data in our basic data, coupon rate is 14%, or it will be interest amount over here, that is 14 rupees divided by 90 rupees. So you get the answer as 15.55%. Those who are still writing, can you please do this in your books now? Yes, so everybody has got 15.55%. I will now write down working note number 2, which they are asking for yield to maturity. So yield to maturity, the formula will be coupon amount plus redemption value minus issue price divided by life whole divided by redemption value plus issue price divided by 2. So that is 14 plus redemption value is 100 minus 90 divided by life is 5 years whole divided by 100 plus 90 divided by 2. That will be 14 plus 2, that is 16 divided by 95. You'll get the answer as 16.84%. Can you please write down this in your books and finish it off? This is working note 3, is it? Sorry friends, this is working note number 3. Sajuddin, current yield, we got the answer as 15.55%. Coupon rate is 14%. They both are not the same. Current yield is coupon amount divided by current market price. Sajuddin, you can do one more thing. You can just go to my website. Okay, there all the videos are available free of cost. Whatever I have taken here, same video, same style is available over there. So it will help you to do a quick revision also. Alright. Alright friends, so you got the answer as 16.84. Friends, this is without time value of money. Am I right? As I told you, exam point of view, you find out this is enough. But for my satisfaction, I would like to find out yield to maturity after considering time value of money, which is the accurate IRR, so that this question gives you 100% exposure. So I'll write down now working note number 4, yield to maturity after considering time value of money. I'll draw a table like this over here. Here, cash flow, discount factor, discounted cash flow. We will take 16.84% as the initial guess rate over here. Alright. So here year 0 I buy for 90. Year 1 to 5 I pay 14. At the end of year 5 it comes to 100. Am I right? Discount factor here will be 190. 16.84% let me take. So I'll get the annuity factor as 3.21 over here. .459 over here. So I'll get the answer as 3.21 into 14, that is 44.95, and down will be 45.90. So my NPV will be plus 0.85. Now since I've got plus 0.85, now I will have to change it and I'll write the next discount factor as 17.84% so that I get a negative NPV. 1 divided by 1.1784. Okay. 2, 3, 4, 5 will be 0.440 that will come over here, and it will be 3.13 which comes over here. From this I'll find out the discounted cash flow, that will be minus 90. 14 into 3.13, that is 43.82, and the last one will be 44. So I'll get the answer over here as 43.82 plus 44 minus 90. I'll get the answer as minus 2.18. Now based on this, I have to now go and I have to find out the IRR. So I will now use interpolation. Friends, let me do that, after which I will give you time to solve it on your own. All right. All right, friends, to find out interpolation, what I will be doing now is I'm having 16.84 and then I'm having 17.84. 16.84 is plus 0.85 and 17.84 is minus 2.18. Right? So the distance to be traveled from here to here would be 3.03. I want a point where my NPV becomes 0. So here to here would be 0.85. So my answer would be 16.84 plus 0.85 divided by 3.03. My answer would be 17.12%. All right, friends, can you please write down this in your books now? Please write down. Once you're done, please chat and let me know that you're done. Yes, Jayashree, Ruchi, Kavita. Good job, that's the right answer. Friends, I hope the pace is comfortable. If you feel I'm going fast, please let me know. Alright? If I'm a little slow, it's okay, but I should not be fast at any cost. Alright? Fine, friends. Have you put up till here in your books? Now, can you draw this interpolation in your books also? Varun, exam, just do one method. Yield to maturity method is enough. You don't have to do it using both the methods. Alright? Its formula is enough, but I'm doing this just because I want to explain average duration also, and I wanted you to get an overall exposure in this one question. Alright? Okay, friends. So I believe you're done with this. Okay. Let's go to the next requirement now, which is duration of the bond. Okay, so I'll write down the next working note heading. Duration of the bond. Friends, let us repeat the logic that we used earlier. So first let us understand using logical method what can be the answer for duration, so that you understand the real logic of duration over here. Alright, let's do it one by one. Friends, what is the coupon rate that is applicable over here? Is the coupon rate turning out to be 14%? Yield, I think we got the answer as 17.12%. And the life is turning out to be 5 years. Am I right? So as per the logic of bond, what I told you earlier, whatever money I make in the bond in 5 years, same money I can make in my father's business in, tell me friends, less than 5 years or more than 5 years? I can do it in less than 5 years because my yield is more than the bond. So my answer or my average duration should ideally be less than 5 years. Alright. Can you please write down this in your books as a logical method? Then I will solve the same thing using table method also, and I'll solve it using formula method also. Yes. Alright friends, if you have written down till here in your books, let's solve it using table methods. I'll give a heading called as method 1. Don't use the word table method in the exam, that's just my terminology so that I can explain this easily to you. Okay. Here, cash flow, discount factor, discounted cash flow, weight into duration. Alright. So here I'll write down 1, 2, 3, 4, 5. This is important. I can't do annuity. I have to put it one by one. 14, 14, 14, 14, 114. My discount factor will now be 17.12%. I'll get the answer as 0.85. You can round off, no issue. 0.73, 0.62, 0.53. The last one will be 0.45. So my discounted cash flow will be, friends, one small tip. 14 is a constant number. So in your calculator, you can do a shortcut. You just have to do 14 into 0.85 equal to. You get 11.9. Then you don't have to do 14 into again. Just do 0.73 equal to, you will get the next answer. That is 10.22. 0.62 equal to 8.68. 0.53 equal to 7.42. Last one will be 114 into 0.45. I'll get the answer as 51.30. Let's add up these numbers now. So I'll get the answer as 89.52. Approximately this answer should be 90 only. It's just a rounding of difference. That is the market price. Value of the asset is nothing but the present value of future cash flows that the asset can generate. Alright. Now let's take the weight over here. Okay. I'll get the weight as 13.3% for the first one. I'll get the answer as 11.41 for the second one. 9.70 for the third one. 8.28% for the next one, and 57.3% for the last one. The total should be 100. Let's just confirm that also. I'll get the answer as 100%. Once I get that, here it will be weight into duration. So 1 into 13.3 will give you 0.133 years. Second one will be 2 into 0.1141 will be 0.2282 years. Third one will be 0.097 into 3, that is 0.291 years. 4 into 0.0828 will be 0.3312. 5 into 57.3% will be 2.865 years. So when I add up all these three, 0.133, 0.2282, 0.291, 0.3312, 2.865, I'll get the answer approximately as 3.85 years. Okay, 3.83 is okay, 3.85 is okay, everything is okay. Friends, here we got the answer as was less than 5 years or more than 5 years? Less than 5 years. Have you now got the answer as 3.85 years over here? Alright. 3.85 years. Okay, can you please write down till here in your books neatly? Mayank Oberoi, one of your doubts is here. What is the impact of increase in inflation? Mayank, I'll be explaining to you how to do the valuation when inflation is also one of the factors. Point number one, we never use the word inflation for bonds. We never say that bonds are inflated. We say that the bonds are growing. I will be explaining that with the help of perpetuity. All right. Yes, Sajuddin, it is very much relevant for decision making, average duration. We get something called as volatility from average duration. I will explain that to you once we do volatility. All right. Once you're done, please message and tell me that you're done. Okay, Ruchijin, you have a doubt that if you take 16.84%, the answer will be slightly different. That rounding off is absolutely fine, no issues at all. Fine, friends. Now, shall we do it using method 2, the formula method? Everyone take a deep breath now. It's a beautiful method. And while solving using method 2, you have to use the board mass approach. What do you mean by board mass? Brackets of division, multiplication, addition and subtraction. So let me rewrite the formula once again. 1 plus y divided by y minus 1 plus y plus n into c minus y divided by c into 1 plus y whole power n minus 1 plus y. Okay. So here the yield, what is coming over here is 17.12%. So 1 plus y will be 1.1712 divided by 0.1712 minus 1.1712 plus c is 0.14 minus y is 0.1712 into the life is 5. So I'll get the answer as negative 0.156 whole divided by 1.1712 raised to 5, right? 2, 3, 4, 5 minus 1, whatever answer I get over there, multiply with 0.14. So I'll get 0.1685 plus 0.1712. Alright, that would be 1.1712 divided by 0.1712, that is 6.84 minus 1.1712 minus 0.156 will be 1.0152 divided by 0.1685 plus 0.1712 will be 0.3397. Right? 1.0152 divided by 0.3397 is 2.98, that is 6.84 minus 2.98, which will give you the answer as 3.86 years. Friends, is this not approximately the same answer that we got earlier? Can you please write down this in your books? Yes, Gauri Shankar, you can do it using 16.84 in the exam, nothing wrong, you will be getting full marks. Well, Mayank, you want to get some good book on fixed income securities? We will definitely, I'll get back to you on that one part later on, alright? You can refer I.M. Pandey, who is an IIM professor. He has written a beautiful book on not only fixed income securities, on all the areas, but the book is huge. It's around 2,500 pages. You can go through it later on once you get through the examination. That will be good for you. Okay. Yes, Shubham Sahai says you can take 16.84 instead of 17.12. Your answer will still remain the same. Once you are done writing this, please chat and let me know that you are done. Alright, so everybody is done with this. Great. So we are getting almost the same answer. There's a little deviation, that's 0.01 is absolutely fine. Now let us go and read the next question. They are asking for volatility of the bond. Friends, I will tell you the volatility of the bond. I will give you the formula also here and the logic also here only. Alright. First let us put the formula and solve it. Then I will tell you the logic. Volatility is equal to average duration divided by 1 plus yield. Alright. So here it will be 3.85 divided by 1.1712. You will get the answer as 3.28%. Can you please write down till here? Then I will tell you the logic of volatility. Alright friends, if you have written down till here, let's give a heading called as logic. I will now explain the logic to you. Yield, price of the bond. Right now, the yield is 17.12%. At this yield, the price of the bond is 90. My question to you is, if the yield goes up to 18.12%, what will happen to the price of the bond? Will the price of the bond go up or will the price of the bond comes down? Yeah, Ruchi, when the percentage changes, the duration drastically changes. Still, your answer is logically right because conceptually you have not done anything wrong. It's just that you have taken YPM without considering time value of money, and which is one of the practices accepted by the exams. Okay, fine. Now let me get back to volatility. So in order to find this, let us draw the table here. Cash flow, discount factor at 18.12%, discounted cash flow. Here let me just put it, year 1 to 5 you are getting 14, at the end of year 5 you are getting 100. So 1 divided by 1.1812, 0.434, 3.12, 43.68, 43.4. I'll be getting the answer as 87.08. So when the yield goes up by 1%, my price falls down to 87.08. Let me find out what is the fall happening over here now. Okay, 90 minus 87.08. My price is falling by 2.92. So now tell me what will be the fall happening in percentage. 2.92 divided by 90. My fall is happening by 3.24%. Friends, earlier what was the volatility that we got? Have I got the answer as 3.28%? Is this approximately the same answer? We got a slight deviation only because of rounding off. So now you tell me what is the logic of volatility. Volatility will tell you how much will be the fall in price for every 1% change in yield. Can you please write down this in your books now? Once you are done writing this, please let me know. Alright friends, if you are all done, I'll just give a theory or for this one, that volatility implies what will be the percentage change in price for every 1% change in the yield. Can you please write down this definition also in your books? Brindasri, we call it as the average duration because we are taking the weighted average year into weight. That is how we get the duration. Year 1 into weight, year 2 into weight, year 3 into weight. Hence we call it as the weighted average duration. Alright friends, I hope you are done with this. Okay, so now let's go and read through the next part of the question. Now they are asking, calculate the expected market price if increase in the required yield is by 75 basis points. Alright. So I will now write down the next working note heading. Revised price if yield increase or decrease? Increases by 0.75 percentage, that is 75 basis points. Alright. Now I'll write down point number A. Current price. What is the current price? 90. Okay. What is the volatility that we got over here? Have we got the answer as 3.28 percentage? Therefore, change in price if yield changes by 0.75 percentage, that will give you the answer as 2.46. Therefore, the revised price will be 90 minus 2.46 percentage, that is equal to 87.79 rupees. Can you please write down till here in your books now, friends? Alright friends, have you all put up till here in your books? Okay, if you have put up till here in your books, can I go to the next final requirement of this question now? Let's read through the final requirement. Assuming that the intermediate coupon payments are not available for reinvestment, calculate the realized yield on X Limited. Alright, so friends, now I'll go to the final working note. Realized yield if intermediate coupon payments are not available for reinvestment. Friends, as I told you, first and the most important part is for us to find out that understanding the question is the most important part. So when they are asking realized yield, what is the meaning of the word realized yield? Friends, whatever it is yield only. Yield is nothing but in the long run it should be nothing but the IRR. IRR is nothing but the rate at which NPV becomes zero. Am I right? Okay. So if this is the scene, we basically want to find out the rate at which NPV becomes zero. And when they say intermediate coupons are not available for reinvestment means year 1, 2, 3, 4, 5, I won't be given 14. But at the end of year 5, I will be given 14 into 5, that is equivalent to how much now? 70 rupees. Okay, so I'll just show you over here how we have to solve this. Here, cash flow, discount factor, discounted cash flow. Year 0, I will buy for 90. Year 1 to 5, there won't be any cash flow at all. At the end of year 5, I will be getting 170. How did I get 170? 100 plus 14 into 5. At some discount factor, my NPV should become 0. Now, whatever be the discount factor, this will remain at 1. So here I'll get the answer as what? Minus 90. Okay. This is 0. So whatever comes over here doesn't matter. This will turn out to be 0. Here if I get plus 90, then automatically what will happen? My NPV becomes 0. So if I do a backward working, my discount factor for the 5th year should be 0.529. Can you please write down till here in your books? Alright friends, if you have written down till here, now we have to ideally find out 0.529 will correspond to what discount factor. Exam point of view, you can either do it using the present value table or by using the calculator. I would suggest strictly depend only on the calculator, because exam we don't know whether I will be getting this present value table or no. Alright, so let me just come back over here. Let's now discuss and do it together. Alright. So here the thing would be, I'll just start with a guess rate of 15%. You can take any guess rate. I am getting the PV factor as 0.497. I need the PV factor to be how much? 0.529. So this is not right. I will then try doing with 14%. Let me try with 14%. That will be 0.519, very close to the number that I want to find out. Akshatcha, I will go and show you the previous slide. Let me just complete this. Let me try 13%. 13% would turn out to be 0.542. So that's going too high. Let me now try 13.5%. I get the number as 0.530. This is very close to 0.529. So I will just write down below that in the exam that 0.529 from the PV table, or I'll write down over here 0.529 from the PV table corresponds to 13.5%, and I will finish it off. Can you please write down till here in your books? Akshat Shah, when you meant previous slide, I'm assuming this is the slide you're talking about where the whole calculation for the last working note is being done. Nani Balu, yes, we are doing the conversion problems also, and we'll be doing the bond recalling or bond refunding sums also. All right. Once you're done, please let me know. Alright friends, I hope you are all done with this. Okay, shall we now go to the next part? Shubham, you can use interpolation, nothing wrong. You will get the same answer. Yes. Okay. So friends, we are done with this question also. And ideally the bond part is fully done. But as one student requested, let's do a question on bond refunding also, which many are finding it very important and a little bit difficult. Give me a minute. I'll just open that part. Okay, this is a question on bond refunding now. Friends, I'll give you 2 minutes. Can you please read through the question and try understanding this question? In the meanwhile, I'll just fill my water and get back. Okay. Yes, 13.58 is the precise answer, Rangesh Badri. That's good. Can you please go through this question? I'll be back in a minute. Alright friends, shall we now do the basic data together? Okay. Working note 1, basic data. Point number A. Sir, Earth is having 11% bonds worth 2 crore outstanding with 10 years maturity. And they are contemplating a new 2 crore bond which is having a coupon rate of only 9%. So we are having two types of bonds over here. One is the old bond and the other one is the new bond. Okay. So I'll first write down coupon rate of old bond. Which turns out to be 11%. Point number B, coupon rate of new bond. That is turning out to be how much? 9%. After that, they have told the face value of both the bonds is turning out to be how much now? It is turning out to be 2 crore. Alright. Then they have told life is turning out to be how many years? 10 years. Alright. Then once we come down, they have told unamortized portion of the issue cost of the old bond is how much? 3 lakhs. Unamortized portion of issue cost is equal to how much? 3 lakhs. After that, they have told this can be written off no sooner the old bonds are called off. Called off means we are going to repay the old bond. Okay. Tax rate is 30%. And the cost of debt is told to be 7%. They have also told issue cost of new bond that is equal to 2.5 lakhs. And the last part that they are saying is call premium is 5%. I'll write down point number, last point over here itself. call premium is equal to 5%. Can you please write down this basic data in your books now? Alright friends, I hope you have all written the basic data in your books now. Okay. Once you're done with the basic data, we will now start cracking this problem. Friends, in this problem, you must understand there are two types of bondholders. One is the old bondholder and the other one is the new bondholder. So we are going to repay the old bond and in this place we are going to issue the new bond. So this is not exactly a bond problem. It is more of a capital budgeting problem. Alright. And when we do a question on capital budgeting, there are mainly three types of cash flows. The first one is called as initial outlay. The second one is called as in between cash flow. And the third one is called as terminal cash flow. Can you draw this chart in your books, friends? Varun Menon, where can I find this question in your material? Once I share the handout, you will get all these questions. Alright. The material will be handed over to you by today evening. Tomorrow morning, when the class starts, you will be able to download the material. Alright. Alright friends, if you have put up till here, so let's solve it one by one. So I'll write down now working note number 2, initial outlay. Okay, let us put it one by one. First, what will happen? I will issue the new bonds. Am I right? So when I issue the new bonds, how much money will I get over there? I will get 200 lakhs. I'll give a heading called as rupees in lakhs. Is this inflow or outflow? This is inflow. Point number B, I will repay the old bond. So when I repay the old bond, it will turn out to be minus 200, which will be the outflow. Varun Menon, if you have my book, then you should go to the chapter of different types of capital budgeting. This question will come over there. Alright. Okay, now I'll write point number C now. Issue cost of new bond, repay of the old bond. After this, what are the details given over here? Coupon rate 11% will happen from year 1 to year 10. That is in between cash flow. I will not consider that in initial cash flow. Face value 2 crore is okay. Life 10 years is okay. Unamortized portion of the issue cost will come in year 0 itself. Because the moment I repay the old bond, I can write off this. Once I write off, I will get a tax benefit. So I'll write down point number C. Tax benefit in writing off old bonds. Formula will be 3 lakh into 30%. That will be 90,000. Friends, and I don't think I can give a heading in lakhs. I will give lakhs here separately. This is what inflow or outflow. This is going to be inflow. Once I write down this, after this I'll go to the next part. Unamortized portion of the issue cost is told, tax rate is told, issue cost of the new bond. Okay. Next point will be issue cost of the new bond. New bond is having a price of 2,50,000, but I will have tax outflow, so only 0.7 is my net effect. So 2.5 into 0.7, 1,75,000 will be my outflow. After this, the last part, what they have told is Call premium 5%. Friends, call premium is what? Is it an inflow or is it an outflow? It is an outflow. It is basically calling the old bond. So when I called the old bond, I will end up paying a premium on that. So the formula will be 200 lakhs into 5% into 1 minus 30%. I will take the tax benefit also. So I'll get the answer as 7 lakhs over here. This 7 lakhs also will be my outflow. So friends, my net cash flow will be 7 lakh plus 1 lakh 75,000 outflow minus 90,000. So my net outflow will be 7 lakh 85,000. I'll give you a minute. Can you please write down this in your books now? Sajuddin, which is a capital payment over here, I don't understand. Are you meaning to say call premium? See, call premium is an expenditure. So once we book an expenditure, we will get tax benefit on that. Am I right? Alright friends, I hope you have all written down till here in your books. So friends, I told you we have to go by 3 steps. Initial outlay, in between cash flow, terminal cash flow. Am I right? So now that I have put up till here, I will now go to the next working note, which is going to be in between cash flow. Alright? In between cash flow, I will put it this way. Savings on interest, that is the main thing that happens in the in-between cash flow. On 200 lakhs, I was earlier paying 11%. Now I have to pay only 9%. Am I right? Let me just confirm this part. Yes. So I'm saving flat 2% on 200 lakhs, which turns out to be 4 lakhs. On this 4 lakhs, once I save, I will have to pay tax at the rate of 30%. So 4 lakh into 30% will give me the answer as 1,20,000. Therefore, my net interest savings every year will turn out to be 2,80,000. Can you please write down till here in your books now? Tax at the rate of Alright friends, so we are done with the initial cash flow. We are now done with the in-between cash flow also. Now we go to the final one, working note number. I think I've missed out on the working note number. This is working note 3. So this will be working note number 4, terminal cash flow. Friends, here we will have some debate. It is a little complex. Listen very carefully. Terminal cash flow will be 0. There is not going to be any terminal cash flow. I will explain this to you now. Listen very carefully. I will explain with the help of a chart. Let's take this as year 0. Okay. I will call this as year minus 10. And this one I'll call it as year plus 10. Year 0, old bond, I am making a repayment of minus 200. New bond, I am receiving 200. My net cash inflow becomes 0. Am I right? Ideally speaking, 10 years back, on the old bond, I would have got plus 200. Okay. This is ideally not considered by me. Am I right? Because I'm doing old bond versus new bond. This old 200 is considered. This is also considered. Am I right? So year 0, old bond repayment considered, new bond inflow considered. But year minus 10, 200 inflow not considered. Now year 10, actually what is happening? New bond, I am repaying another minus 200, I can show it. This also will not be considered. Otherwise, we will be doing a wrong calculation. Let me explain in a different style. Look, ideally when we do a bond valuation question, year 0, I put some money, I get coupon, I get redemption value, happy. So year 0 outflow is there, year 10 inflow is there, happy. Here, year 0 outflow or inflow is 0, then year 10 suddenly I show a big terminal cash flow of outflow or something like that. Definitely my NPV will become negative. Or what we should do, year minus 10 cash flow also we should consider, year plus 10 cash flow also you consider, then it's okay. If year minus 10 I am not considering, year plus 10 also I should not consider. Can you draw this chart in your books now? All right. All right, friends. So you can just give a note. Terminal cash flow will not be considered since the original inflow on the old bond was also not considered. Can you please write down this in your books now? Well, Jerry, old practice manual questions are coming in the exam, so that's very, very crucial. Study material is also extremely crucial for all of you. Okay. Alright friends, Shubham, the issue cost treatment is very straightforward. The issue cost which is coming over here was 2,50,000, right? The moment you do this, as per accounting standard on intangible asset, it has to be written off as an expenditure immediately. You cannot apportion it. Why? Because for recognizing an intangible asset, there are two conditions. Future economic benefit should be there and the cost should be measured reliably. Here, future economic benefit being a debatable point, as per the accounting standard, they have given a clarification. All the issue cost, etc. has to be written off immediately. So the moment you write it off, you get 30% tax benefit. As simple as that. Fine, friends. Ramani, your question is, if they issue a new bond for a more value than the old value, the differential value will definitely come. Understood? And the differential value will also come in year 10. That's a very good doubt. Let's say, for example, 2 crore is the old bond. 210 lakh is the new bond. This 10 lakh will come as inflow in year 0 and the same 10 lakh will come as outflow in year 10 also. So see, year 0, 10 inflow has come, year 10 lakh outflow is going. It will make sense then. Okay. Yes, Akshat Shah, old bond you write off immediately. This question says the company followed an accounting where the old bond was amortized, which was actually not correct. So now once the new bond is issued, as per the accounting standard, new bond has to be written off immediately. So old bond, whatever is written off immediately, we can claim it as expenditure under the Income Tax Act, and there we can claim the 30% tax benefit also. Okay, Srinidhi, I'll repeat once again. Old bond 3 lakh was the balance outstanding. The moment I issue the new bond, I will write off my old bond. The moment I write off my old bond, I will get flat 30% benefit. So I will get 90,000, which becomes my inflow. This 3 lakh is only an accounting thing. The money has already gone many years back. Now it's only kept as an asset in the books because of an accounting policy what the company was following. That is absolutely fine. 3 lakh is not an outflow. It was already gone. Now 30% will be the inflow. That's all. Sajuddin, yes, time value differs and the cash flow also differs. So we should take the year time correctly where the cash flow has happened. That only we should be showing. Alright friends, I hope you are clear with this part also now friends. So now once you have written down till here, I will go to the final working note where the heading will be NPV. Here, cash flow, discount factor, discounted cash flow. Here, year 0, my cash flow turns out to be 7,85,000. Year 1 to year 10, my cash flow turns out to be 2,80,000. Year 10, the cash flow will be 0. My discount factor will turn out to be, how much percentage have they told in the question? Just check, 7%. Okay. So let's do it together. Here it will be 7,85,000. 1 divided by 1.07. That will be 7.02 into 2,80,000 will give me the answer as 19,66,602. So I'll get the NPV as plus 11,81,602. Let me just cross check friends. Yes, that's right. So friends, now tell me, is the NPV positive or negative? The NPV is positive. So I'll write down since NPV is positive, the company should refund the bond. Can you please write down till here in your books now? Manikam Gopinath, I am doing only those questions which is applicable to old and new. I am not doing any question as of now which is applicable exclusively to new or exclusively to old. I will be giving you a difference between those two separately later. Alright? Yes, Shubham, your answer is right. So I hope everybody has put up till here. Alright friends, if you are done with this, we are done with this question also. Now shall we go to the next basic chapter for today? Tomorrow we will be doing advanced chapters. Let us first quickly cover up and close the basic chapter. Write down the next chapter's name, dividend policy. Friends, this chapter as such is not there for the new syllabus, but what I am going to cover is there in the new syllabus in the chapter called as mergers and acquisitions or the chapter called as business valuation. Alright? Okay. Dividend policy. Fine. Fine friends. Let us now quickly start cracking a problem on this. First, write down concept number 1, Gordon's model. Very important for new syllabus, even more important to new syllabus than the old syllabus. Alright. Here, the question what they are trying to answer is the same thing. How to value a share. Alright. Now everybody interact with me. How do you value any asset? The value of any asset is the present value of future cash flows that the asset can generate. How do you value a bond? A value of a bond is also nothing but the present value of future cash flows which the bond can generate. Now tell me, how do you value a share? Value of a share is also the present value of future cash flows which a share can generate. Can you please write down this heading in your books? Give a heading called as Gordon's model, and can you please write it down? Anju, the weightage I will show you in the study material itself. It's directly given. You can actually check it for yourself, or else I'll do a screen sharing and I'll show you the weightage for forex and the weightage for derivatives. All right. Can you please write down till here in your books, friends? All right. So friends, if we want to find out the value of a share, there are basically two parts to this. Okay. One is what will be the future cash flow. Okay. And the other one will be the discount factor. Now tell me, as far as a share is concerned, what are the mainly returns that a cash gets over there, share gets over there? One is, as an investor, if I put 100 rupees and I buy a share of a company, I will either get dividend, or what will I get? I will get a redemption value. Am I right? So ideally the value of a share should be the present value of dividend and redemption value. But friends, there is a little twist. It is from my point of view. I am the investor. My point of view, what you said is right. There is redemption value. Now think from company's point of view. I sell the share. Suppose I am Tarun. Tarun is selling the share to, let us say, Shubham. Alright. For Tarun, it is inflow. For Shubham, it is outflow. So if I sell a share for 100, I get 100. Shubham pays 100. Can I say the net cash flow becomes 0? So redemption value actually creates a nil effect because I have inflow, other fellow has outflow. Company point of view, there is no cash flow involved only. So even as an investor, what bothers most is only the dividend, which is the future cash flow as far as a share is concerned. Moreover, we have a concept called as going concern. What do you mean by going concern? Going concern means that the company will go on forever. Are you getting my point? And the discount factor, if you talk from a share investor's point of view, only equity holders are the investors over here. So if equity holders are the investors, the expectation will be called as KE. Now, if this is what you have understood, so this means the value of a share is present value of future dividends which the investor receives towards infinity, or infinity is something what we call it as perpetuity. Can you please write down till here in your books first, friends? Draw this chart in your books first. Alright friends, have you put up till here? Now can you write down this also in your books? Alright friends, if you have got the written down till here in your books friends, let me first explain the concept called as perpetuity, then we will go back to Gordon's model. So subconcept number 1, perpetuity. Alright, let me now explain the logic of perpetuity and the formula for perpetuity, then I will correlate this with the formula for Gordon's model. Okay, now for this example, I want one young handsome guy who is attending my lectures right now in this YouTube channel. Let me just take a name randomly from over here. Okay. Okay, I'll talk about Duryodhan over here. Okay. Let's assume, assume Duryodhan is a young handsome guy who is attending my lectures right now. Okay. Duryodhan is attending my lectures and it is afternoon time. Duryodhan is very hungry. So Duryodhan will go to his favorite restaurant to have a nice heavy meal after a stressful SFM lecture what he has attended. So let us assume he will go to a Taj for having his lunch. Alright. He will go there, he will sit on his table and he will be waiting for the waiter to come and take an order. That is when next to his table he will see a very nice beautiful girl sitting over there and having lunch. The moment he sees this beautiful girl, Duryodhan will fall in love with that girl immediately. And that moment he will forget all his hunger. What Duryodhan will do right now is that he will immediately get up from his table, go right to the next table, and after going to the table, he will just go in front of the girl, kneel down in front of her and tell her, I love you, will you marry me? Now tell me friends, what will the girl do? Yeah. Many of you have guessed it right, the girl will slap. Friends, slapping has become a natural right of every woman over here. Let's not debate on that now. Let me come back to the example. Friends, Duryodhan made one mistake. The mistake what he made is that he believed in just love at first sight. You should first understand the person and then fall in love. So in this case, Duryodhan just blindly went to a girl and just proposed to her without even knowing who this girl is. Unfortunately, this girl was a mental girl. Mental in the sense, she had just come out of a rehab and she was badly addicted to chocolates. Now this girl is sitting there craving for chocolates. That is when this guy called Duryodhan is coming all the way and proposing to her. So this girl understood one Bakra is there sitting right in front of me, and this girl decided to take advantage of the situation. This girl told to Duryodhan, okay Duryodhan, I will marry you, but one condition. You have to get me 365 family packets of dairy milk silk every year on my birthday, and you have to do this forever. Whether you live or you die, I don't care. Now Duryodhan is shocked. All of a sudden, lot of numbers have come into his mind. Now for one moment he will think, let me leave the girl, but he loves her truly. He cannot leave the girl. What he does next is he will open his bag, take out the calculator and do some calculations. Okay, 365 family pack means each family pack will have an approximate price of, let us say, 150 rupees. So 365 into 150, he will understand that approximately the price turns out to be 54,750 rupees. Apart from this, the girl will also demand from him, you know, I don't need only dairy milk, I need some Kit Kat, Snickers and whichever chocolate you like, all round off to 60,000 rupees per year. Now Duryodhan is shocked. That girl rocked. Now Duryodhan is sitting and thinking, what do I do? Oh, let me write down this. What do I do so that I can get 60,000 rupees every year forever, so that I can satisfy this demand of the girl who is asking for so many chocolates? And then Duryodhan came to one more realization. There is something called as inflation. Inflation means the price keeps on increasing. Let us assume the inflation is 5%. This means if year 1 the price of the chocolate is 60,000, year 2 the price of the chocolate will become 60,000 plus 5%. That is 63,000. Year 3 it will become 63,000 plus 5%. That is 66,150, and it will go on. Now Duryodhan is completely upset. He has to do something now so that he can afford 60,000 year 1, 63,000 year 2, 66 150 year 3, plus 5% plus 5% plus 5%. It should go on forever. What will Duryodhan do, assuming that the interest rate in bank is turning out to be, let us say, 10%? I will now tell you what Duryodhan will do. I will give you the solution and then I will tell you how I got the solution. Duryodhan will do one simple thing. He will go and he will deposit 12 lakh rupees in bank at 10%. By doing this, he can afford 60,000 rupees for the first year, 63 second year, 66 150 third year, and it can go on forever, and he can fulfill the demand of the girl, and then that girl will be willing to marry him. Let us numerically check how this 12 lakh can be used for the purpose of getting this returns. I will take a table. Year 1. What is the opening balance that he is putting over there? 12 lakh rupees. How much interest will he get over there? Did he get the interest of 1,20,000? What is the cost of chocolate for the first year? Is it turning out to be 60,000? Friends, I will just check the percentage of cost to my income just to know what I am doing. 60,000 is the cost, 1,20,000 is the interest. So will I be getting 50% as a return coming over here, right? Year 2, what will be my opening balance now? It will be 12 lakh plus 1,20,000 minus 60,000. Will I get the opening balance as 12,60,000? What will be the interest at 10% that I will get on 12,60,000? It will be 1,26,000. What is the price of my chocolates in year 2 after considering inflation? Is it turning out to be 63,000? Now tell me, what is 63,000 to 1,26,000? Is it again turning out to be exactly 50%? Let's try one more year. Year 3. What will be my opening balance now? 12,60,000 plus 1,26,000 minus 63,000. That is 13,23,000. On this, my interest will be 1,32,300 and the cost of the chocolate will be 66,150. Now check and tell me how much is 66,150 as a percentage of 1,32,300. Will I again get the answer as 50%? So tell me, friends, what is the moral of the story? If I invest 12 lakhs, my interest income will always be the double of the cost of the chocolates. So even if my chocolate goes on increasing by 5%, my interest income will always be double. So this can go on forever or this can go on towards perpetuity. Hence, I can conclude that the present value of 60,000 towards perpetuity with 5% inflation is going to be how many lakhs, friends? 12 lakhs. I will now tell you how this 12 lakhs have been arrived. I got this number from my mind. I will now tell you how I got this answer. I got this using a formula. The formula what I actually used without telling you was present value of perpetuity is equal to cash flow divided by discount factor minus inflation. Or my cash flow over here was 60,000 divided my discount factor was 10%, my inflation was 5%. If you do this, you will get the answer as 12 lakhs. Hence, friends, to conclude, the present value of perpetuity can be found out using the formula cash flow divided by discount factor minus inflation. I will give you 1 minute. Don't write anything now. Process the whole information that I have given you. I will then dictate in a proper manner so that you write down the logic and you never forget the logic. I'll give you 5 minutes. The 5 minutes starts now. Alright friends, I will now explain this in a neat manner. What you can do is you can give a question in your book and then we can give the answer. The question what you can give will be, what was the name of this handsome guy? Duryodhan, yes. You can just write a question like this. Duryodhan fell in love with a mental girl who has demanded 365 family pack of Dairy Milk Silk worth 60,000 plus 5% inflation forever. How much should Duryodhan invest today so that he can earn 60,000 plus 5% forever? Can you please write down this question in your books? Sajuddin, if you invest 6 lakhs, the problem will be first year you will get 60,000. Okay, I will explain that to you later. It won't work out. What will happen is your interest income will be less and your cost of chocolate will be more. So that way you will not be able to manage that part. I will write down and show you. First, let everyone write down this and finish it off. Alright friends, I hope you have written down till here in your books. Okay, if you have written down till here in your books, then I'll just go back. Now you write down this formula and this answer. Then I will give you the proof also. Alright. Alright friends, if you have written down till here, now you can go and write down. You can draw this table in your books. Once you're done, please message and let me know that you are done. Alright friends. Alright friends, I hope you have written down till here. Now Sajuddin, what you asked, I'll just quickly share and show you. See, if the amount what you put is 6 lakhs, you will get 60,000 interest. What is the cost of the chocolate? 60,000. First year, happy. Year 2, what will happen is your balance will be only 6 lakhs. Year 2, you will get only 60,000 as your interest income. But the chocolate cost will be 63,000. Your balance will start depleting to 5,97,000. Like this, it will start depleting and one point will come and you will not be able to afford the chocolate at all. But when you put 12 lakhs, you can afford the chocolates forever. That is the logic behind this. Okay. Yes, interest what you are getting, you are reinvesting back only after paying for the chocolates. That you have to keep in mind. Okay. Now, so once you are done with this, now I will go to subconcept number 2. I will now again write down Gordon's model. Here I told you value of a share is the present value of dividends which is coming towards perpetuity. Am I right? It comes towards perpetuity. So here we have to use what formula? The perpetuity formula. What is a perpetuity formula that we have learned? Cash flow divided by discount factor minus inflation. Am I right? Now tell me, when you are talking from shareholders' point of view, what is the cash flow happening over there? P0 is the price today is equal to D1 is the cash flow divided by, I won't call it as discount factor, I will call it as KE because it is equity holders expectation. Discount factor is any investor's expectation minus, we don't call it as inflation. I have never heard anyone saying Reliance price has been inflated. We say that Reliance price has grown. It will be KE minus G. Can you please write down this formula in your books now? Alright friends, I hope you have written down till here. Now friends, I need to go in depth to explain to you model. Alright. So Gordon's model, ideally I can break it up into 3 parts which we need to learn now. Alright. 1, we need to learn how to work out D1. 2, we need to learn how we can find out KE. And 3, we need to learn how we will find out G. Alright. Can you please draw this chart? Then I'll explain to you this one by one. Alright friends, I will now go to the next page and I'll write down Roman number 1, D1. Friends, there are 2 terminologies which people always get confused. D0, D1. Alright. D0 means last paid dividend. Alright. Whereas D1 is used when the word in the exam is either current dividend or when the word in the exam is expected dividend. Current dividend means dividend of the current year which will be paid in the next year. Alright, last paid dividend means dividend which came in the audited financial statements. Can you please write down this in your books because people get very much confused. So D0 is past dividend and D1 is the future dividend. Please draw this chart in your books, friends. Yeah, Denny, horizon value is normally a term used in relationship with perpetuity. I am not very sure where you have seen this word. If you can just share that with me, I will check and get back to you. Alright. Okay. I hope everybody has put up till here in your books. So this was the first part. Now exam point of view. D1, what is the formula? Alright. There can be 2 scenarios. Okay. D1 is directly given. Okay, that is scenario number 1. Scenario number 2 is D1 is not directly given. Okay. Now, if D1 is directly given, in that case, we don't have to use any formula. we don't need any formula. We just have to use whatever is given as D1. Everybody is clear so far? But suppose D1 is not given, then we can use a formula. D1 is equal to D0 into 1 plus G. Can you please draw this chart in your books now? Alright friends, I hope you have written down till here. Now let me explain to you the logic of this formula. Okay, D1 is equal to D0 into 1 plus G. Let us assume D0 is 10 rupees and the growth is 10%. Then the D1 will be 11 rupees. The logic is very simple. Last year the dividend was 10 rupees. Okay, the company normally has a growth of 10%, then the company is expected to give a dividend of 11 rupees in the next year. So the logic, what you have to write down will be like this. Last year dividend is 10 rupees. The company is growing at 10%, hence next year dividend is expected to be 11 rupees. Can you please write down this in your books, friends? Sajuddin, one good question what you have asked. Practice manual have messed up about D1, D0. Some places where they should use D1, they use D0 and they have actually made a big confusion over there. If you want to really understand the depth of what D1 and D0 is, in my website tarunjagdish.com, that video is given with detailed elaboration. Alright, go through that video. Many cases the practice manual is wrong. When they give current dividend, they have used it as D0. That is not practically correct. So you have to do it in the correct manner. Alright. Alright friends, I hope you are clear with the logic of D1. So let me go back. Here we have understood the meaning of D1. If already given, no formula. Otherwise it is what? D0 into 1 plus G. Okay. Next thing is KE. KE means what? Equity holders expectation. And friends, equity holders expectation is actually found out using a very simple formula, which is a CAPM formula. I will elaborate this in portfolio management chapter. The formula is RF plus beta equity into RM minus RF. Can you please write down this in your books now? Yeah, Badri, in exam, as you said, whatever is given in the PM might be the suggested answer. What you can do is you can give a detailed logic of why you have taken this as D1 or D0. So once you put the logic, you are conceptually clear. So once you are conceptually clear, obviously the valuer will understand that you are logically right and he will give you marks. Alright friends, I hope you are clear with KE also. Now we go to the last part, growth. First I'll give you the formula for growth is equal to retention ratio into rate of return. I will then explain to you the logic of growth. Can you please draw this, write down this formula in your books? Alright, let me now explain the logic of this to you. For this, let me take 3 people from this classroom. Classroom means the people attending my lecture right now. Let me take some 3 names. I will take Kavita, I will take Ramani, and I will take Sajuddin. Okay, let us assume Kavita is a spendthrift person. Okay, spendthrift person means whenever she gets money, she will spend entire money. Okay, super partying type person. Ramani is a moderate fellow. He will spend some money, he will save some money. Sajuddin is a super miser. He will not spend even a single penny of money. Okay, assume all the three of them are having 1 lakh rupees with them, which is put in FD, on which they are getting 10% interest. So tell me friends, how much will be the interest which they will be getting for the first year? Kavita will get 10,000. Ramani will also get 10,000. Miser Sajuddin will also get 10,000. Everybody clear so far? So now out of this money, they will spend some money. Am I right? Now tell me, what is the nature of Kavita? Spendthrift fellow. So what she will do is, she will spend the entire 10,000 by partying. Now tell me friends, what is the closing balance of Kavita? No friends, it's not 0, it is 1 lakh. The bank FD is still there friends. Okay. Now tell me, what about Ramani? What is the nature of Ramani? Moderate fellow. He will spend only 5,000 rupees. So what will be the closing balance of Ramani now? 1 lakh 5,000. Now let's talk about Sajuddin. What is the nature of Sajuddin? It will be miser. So as a miser, the moment he gets 10,000, he will close his eyes. I never got any money. Why will I spend? So his expenditure will be 0. And what will be his closing balance? 1 lakh 10,000. Now let us find out what will be the interest that they will earn in the next year. Kavita will earn 1 lakh into 10%, that is 10,000. Ramani will earn 10,500, whereas miser Sajuddin will earn 11,000. Alright. So friends, let us check what is the growth in the earnings compared to the previous year. How I am going to check the growth is, I am going to compare this interest versus this interest. Okay. So spendthrift Kavita last year got 10,000. This year also she got 10,000. Is there any growth in her earnings? The answer is 0. Whereas Ramani last year got 10,000. This year got 10,500. Can I say his earnings has grown by 5%? Whereas miser Sajuddin last year he got 10,000. This year he got 11,000. So what is the growth he's got over there? 10%. So now tell me friends, what is the moral of this whole story? You should be like Kavita or you should be like Sajuddin. The moral of the story is, if you become a miser, then you will be able to make maximum growth, and if you are a spendthrift, you will be able to make minimum growth. Let me now correlate this with the formula and let's do it. Alright, I'll give you time to write down after this. Let me complete the whole example first. First person is who? Kavita. What is the formula for growth? Retention ratio into rate of return. Kavita, did she retain any money with her? 0% she retained. Rate of return was 10%. So she got the answer as how much? 0%. What about in case of Ramani? Out of 10,000 earned, 50% he retained back into 10%. Do you get the answer as 5%? Whereas what about Sajuddin? He retained 100% of the money into 10%. He will get the answer as 10%. 0, 5, 10. Is this the same answer what you got over here also? Hence proven that growth can be found using the formula retention ratio into what? Rate of return. Friends, I will now explain to you practically how this works. Practically, every company has got profits. When they make profit, they have two choices. Either invest the money back or distribute as dividend. Kavita, being a spendthrift, the moment she got profit, she distributed the whole profit. Now she doesn't have any money for reinvestment, hence her company will not grow that fast. Whereas Sajuddin kept back all the money, did not give any dividend, he put back the whole money, and that is how his companies actually grew. Friends, this happens in practice also. Microsoft, Bill Gates was the world's richest man. He did not give even a single penny dividend non-stop for 10 years. Nobody bothered about it because he was going on reinvesting and the company was growing. Amazon, right now doesn't give any dividends. Why they do that is because they reinvest the whole money, and that is how they are growing. That is why Amazon has taken that profit and they came to India for investment. That is how the companies grow. Facebook made profit. It didn't distribute. It invested in Reliance over here so that they can grow together. So friends, the more you reinvest, the more you grow, and the less you reinvest, the less you will grow. Can you write down this in your books now? Sajuddin, in real life, you are saying you are not a miser. We will meet up one day. You give me a good treat. I am waiting for that day. Okay? Yes, Berkshire Hathaway, Warren Buffett. He is an amazing personality. We'll speak about him when we do the chapter of portfolio management. One of my role models. I love that guy, Warren Buffett. Alright friends, have you all put up till here in your books? If yes, I'm going to the next page now. I think you're still writing, let them finish. Alright. Now write down this also in your books. Alright friends, I hope you have all put up till here in your books. Okay, if you are done with this, now I'll conclude the Gordon's model with a final heading that you write down in your books. Practical application of Gordon's model. Now this is what comes in business valuation for the new syllabus, but has also come for the old syllabus. Alright. VJ World, no, it is both old and new only I am taking. I am not taking anything which is exclusively old or exclusively new. Friends, now let's understand practically how this applies. Friends, if you want to learn share trading, okay, I will give you a good app with which you can learn share trading free of cost, because I won't get time to show you here in my live classes or my face-to-face classes. I normally ask everyone to install an app and then I show them how trading happens. But here, since we have less time, that won't be possible. Install this app called as IIFL. Okay. When you're installing this app, okay, you will get a call from them asking you to buy shares, etc. Tell them I want to just learn the app first, then I will think of investing. One call is for sure. So that one thing you have to tolerate. But inside this, when you go top left, okay, there is a button on which if you click, an option button will open up. There is a thing called as virtual portfolio. Okay. The best thing about this virtual portfolio is that it is actually the numbers which is happening in the share market. All right. But you don't have to do that. What you have to just do is you have to click on the virtual portfolio, buy share, sell share without having any money. It will be more like a video game. Understood? So ideally, let's say you buy a share for 1 lakh. You don't have to pay any money. Then you can predict whether price is going up or coming down. If you do this properly for 2 to 3 months, you will understand the share market properly. Only after that you put proper money. Otherwise, you lose a lot of funds in that. And one other, amazing app is Zerodha, but it does not have virtual portfolio. It is used only for, you can do your trading on your own with zero charges involved. It's one of the very best apps that I normally use for my trading purposes. All right. Now, practically, let's understand how this works. Let us take one share. Let us say we are talking about Infosys shares. Let us say the actual market price of Infosys shares right now, if you go to the IIFL app and see, let us assume the actual market price is 100 rupees. Now you are confused. Should I buy the share or should I sell the share? So what you will do is you will have to find out what should be the price of the share. Okay. Using Gordon's model. This is what we call it as theoretical price. Okay. So once you get the theoretical price using Gordon's model, we can compare. The price should be this much, actual price is this much, hence I should buy or I should sell. Now, Gordon's model, what is the formula we learned? I will write down over here step by step, okay? P0 is equal to D1 divided by KE minus G, okay? Now, I'll come down below that. So there are three main things over here. 1 minute, I'll just change the color so that you get a grip on the whole thing. We need to find out D1, we need to find out KE, and we need to find out G. Let me start with D1. Alright. If you're talking about D1, we know D1 is equal to D0 into 1 plus G. Am I right? D0 I will get from the audited financial statements of Infosys. That is the previous audited financial report will be D0. Alright. What is the formula for G? It is going to be retention ratio into what? Rate of return. Am I right? Okay. Once you get this as, retention ratio into rate of return. So now I'll write down the next part. How do you work out the retention ratio? Okay. That will be nothing but 1 minus payout ratio. Am I right? How do you get the payout ratio? I will just write down the formula here. Payout ratio can be found out from the audited financials using the formula DPS divided by EPS. For example, if dividend is 5, earnings is 10, your payout ratio will turn out to be how much percentage? 50%. That's just an example. Okay. So I get the payout ratio. From that I can get the retention ratio. Then I have to find out the rate of return of Infosys. Friends, rate of return is nothing but ROE. ROE is nothing but return on equity, which can be found out by using the formula profit after tax divided by equity plus reserves, and this can again be done from financial statements. So basically you need the audited financial report of Infosys. That is what even Warren Buffett uses to decide whether I should buy or whether I should sell. So once you get these two things, you can find out the growth using the formula retention ratio into rate of return. So the moment you do this, I will get D0, I get growth, I can find out D1. Okay. What is the next thing that I'm supposed to find out? KE. KE can be found out using the formula RF plus beta equity into RM minus RF. This I will show you practically once I do the chapter of portfolio management. For time being, the question will give what is KE. Last thing is what G. G is nothing but retention ratio into rate of return. We already discussed this. So after I do all these things, I can find out P0 is equal to how much it should be. I'm stressing on the word how much it should be, not what it actually is. So let us say, I'll give you two situations. Situation 1, situation 2. Let us say the actual price is 100, but the theoretical price that it should be only 90. Right now it is 100. Very soon it will fall down to 90. Right now it is overvalued. Should I buy or should I sell? I should sell. But suppose the price should be 110, then right now it is undervalued and I should buy. This is how practically this Gordon's model valuation is done, so that you can decide whether you should buy a share or whether you should sell a share. I will now give you 5 minutes time. Can you please write down this in your books, friends? Theoretical All right, friends, I hope you have all written down till here in your books. Okay, can you write down this also now? Babita, tomorrow's revision topic will be portfolio management. Right. Fine, friends, I hope you have done till here. Now you write down this also in your books. Alright, friends, I hope you are done with this part also. This is how practically we decide whether we should buy a share or whether we should sell a share. Friends, we are having 10 minutes left. Can we quickly do one more question and finish off with this chapter as of now today itself? So tomorrow we can start fresh with portfolio management. Alright? Okay. So friends, let me take the next question. Alright friends, can you please read through this question? I'll give you a minute. Please read through this question. After that, we will discuss it together and do it and finish it off. I'll go a little fast on this question, friends, since we have only 10 minutes. Please, anyways, the recording will be available. If you don't understand, you can replay it afterwards. Alright? Alright friends, in this question there is no basic data required. They have given everything in the table itself. 8% debenture, 10% bond, equity shares they have given, reserves and surplus, assets, etc. is given. From this we can find out some hidden information. Okay, so let me I'll write down over here working note number 1. Analysis. All right, they have given equity share 10 rupee each, and then they have given over here 100 lakhs is the total value. So can I find out the number of shares as 10 lakhs from this? So point number A, number of shares is equal to 10 lakh shares. Okay, that is 100 lakh divided by 10. Am I right? Down they have given the assets is 600 lakhs. Asset turnover ratio is 1.1. From this I can find out my turnover. My turnover will be 600 into 1.1, that is equal to 660 lakhs. Alright. The next point that is given over here is they have given the effective interest rate is turning out to be how much percentage? 8%. From this I can find out the effective interest amount, which will turn out to be 125 lakh for the bond debenture, 50 lakh for the bonds into 8%. So 175 into 8% will turn out to be how many lakhs? 14 lakhs. Alright. The next point that is given below is tax rate. Operating margin is given as 10%. From this I can find out the operating profit will turn out to be 66 lakhs. How did I get that? 660 into 10%. Alright. What is the next thing that is given over here? Payout, etc. We have to do it separately. Can you please write down till here in your books now? Pavitra, my revision material, you will get it by tomorrow morning. It will be available in my website. Okay. Alright friends, I hope you have written down till here in your books. Now based on this, they are now asking you to draw the income statement for the year. Alright, so I'll write down working note number 2. income statement for the year. Alright, in that I'll write down point number A, revenue. Have we got the revenue as 660 lakhs? Point number B will be operating expense. We already know what is the operating profit. That is turning out to be 66 lakhs. Am I right? Give a heading in lakhs. So this will turn out to be 594 lakhs. Am I right? So once I get the operating profit, after getting the operating profit, I will write down the interest. We got the interest as 14. Therefore, my profit before tax will be 52. If my PBT is 52, my tax will be 52 into 0.3. Am I right? Is 30% the tax or 40%? It is 40%. 52 into 0.4 will be 20.8. Then my profit after tax will turn out to be 52 minus 20.8, that is 31.20. Then I'll write down the next one, dividend. They have told they are paying out how much percent as a payout ratio? 16.67. 31.2 into 16.67 will be 5.20 lakh will be the dividend, and my retained earnings will turn out to be 26. That is nothing but 31.2 minus 5.2. Can you please write down till here in your books now? Alright friends, I hope you have written down till here in your books now. Okay, if you have put up till here in your books, I am going to the next page now. The next requirement is calculate the sustainable growth rate. Friends, sustainable growth rate is nothing but the growth rate only. So we know the formula for growth. What is the formula for growth? It is retention ratio into what? Rate of return. Alright. So G will be equal to, if 16.66% is the payout ratio, 83.33% will be the retention ratio. Rate of return is nothing but ROE, that is profit after tax divided by equity plus reserves. So how much was the profit after tax that we got over here? 31.2 divided by how much is the equity plus reserves that I get over here? I need to check the question for that, I believe. That is 100 plus 300. So I'll get the answer as 31.2 divided by 400. That turns out to be 7.80%. So growth will be this into 7.8%, which turns out to be 6.50%. Everyone please check. Yes, can you please write down till here in your books now? Alright friends, I hope you have got the answer as 6.5% over here also. So we are done with the second requirement also. Shall I go to the next page now? Okay. The next one is they are asking to find out the fair price using dividend discount model. Working note number 4. Fair price using dividend discount model. Alright, so we know the formula. Dividend discount model is nothing but the Gordon's model. Okay, So P0 is equal to D1 divided by KE minus G. So I have to do it one by one. D0 is equal to what? D1 is equal to D0 into 1 plus G. D0 will be the dividend given over here, that is 5,20,000. It will be 5,20,000 divided by, we got the number of shares as 10 lakh shares. So we'll get the answer as 0.52 rupees per share. Therefore, D1 will be 0.52 into 1 plus 6.5 percentage. We'll get the answer as 0.5538. Therefore, P0 is equal to 0.5538 divided by KE. KE I believe is given the question directly over here. Otherwise, we had to use CAPM formula. Yes, they have given the KE as 15%. Okay, 15% minus G. G means what? Growth. What is the growth that has been found out over here? 6.5%. So divided by 8.5. You get the answer as 6.51 rupees per share. Alright, this should be the price. Everybody is clear so far? I'll give you a minute. Please write down this also in your books. Ruchi Jain, you have a good doubt why 26 is not added to the retained earnings. The assumption is that, see, the audited financials are given in the question. So that will definitely incorporate 26, right? So that 300 and 100 is after incorporating the 26 also. You draw P&L first, then you go to the balance sheet. You don't draw balance sheet first and then do P&L. Am I right? Pavitra, these are all practice manual tough questions only that we are doing over here. And that's all that we are discussing. Each of these questions you can go check. It is there in the practice manual. The only issue is I don't know exactly which is the question number in the practice manual. But once you just brush through it, you will come to know that this has already come in the practice manual. Alright? Okay. Last point. Let's go to the last requirement. What is your opinion on the investment in the company's share at the current price? The current price is 14. So I'll go to the last working note. Opinion on investment. Okay. Actual price is given in the question as how much? 14. What is the theoretical price that we got using the Gordon's model? We got the answer as 6.51. Friends, this means the price is going to fall down very soon to 6.51. So is it undervalued or overvalued? It is right now overvalued. Very soon it will fall down. So before it falls down, what am I supposed to do? I am supposed to sell. Can you please write down this in your books, friends? We are done with this question, friends. Once you are done, please chat and let me know that you are done. This question number 23, chapter 6, security analysis. Thank you so much, Ratna Kumari. All these are only practice manual or the study material problems. All the tough ones only I am doing. I won't do even a single easy question over here. We don't have time for that right now. Excellent. So friends, we are done with this and we are done with today's whole session. Hats off to all of you who have stayed on, learned this, even though it was not easy for any one of you to sit for 3 hours continuously and 2 hours in the morning. But friends, in these 5 hours, we have done the whole revision of the basics, bond valuation and the dividend policy part applicable both to the new syllabus and the old syllabus. I have a small homework for you for tomorrow, friends. Tomorrow morning 7:30, I will start with portfolio management. Alright. So I have a request, not a force. If you can do it, do it. If you have other plans, it's okay. But anyways, I'll be covering everything. I showed you my website today morning, right? I'll just take my website again. I'll click on the concept videos. Tomorrow we are doing portfolio. So my only request is that if you learn things in advance, it will be far easier for you to understand it. It will become a double revision tomorrow when you come. Here if you see friends, on the right side, you will be getting all the details of the chapters are available. Now basics, bond valuation, dividend policy, risk analysis is old syllabus. Then you see it is portfolio management from here. We are having approximately 18 videos on this. Each video will be 10 minutes or 15 minutes or 5 minutes. It will be like it depends on the concept. So every logic is given over here. Logic of actual return, covariance, combined return, etc. If you can just go through these videos once and understand the whole thing once, tomorrow morning when you come and attend my class again, it will become very, very easy for you to complete the entire thing, and we can do a double revision. So today one revision, tomorrow morning second revision. Very quickly we can close off with this whole chapter of portfolio management also. But if you cannot do it, I am totally fine. We will anyways be doing the whole thing tomorrow. Just for your benefit, I request you to just go through it. Just have to go on each one of them, click, and the videos will start playing. So shall we wind up today's session with this, friends? Thank you so much for your patient listening, friends. Thanks a lot. See you tomorrow morning at 7:30. I will be sharing the link in the RPL Telegram channel. You can either go to Telegram channel of RPL, or you can add my Telegram channel. This link will be available everywhere. You can in fact view the whole live class in my website also. There is something called as live over here. You just click on this live, and the entire YouTube live and everything is going to come over here. From here also you can pass comments and do the same way how you're doing in YouTube also. I hope you are clear with this, friends. Thank you so much. Have a nice day. See you tomorrow morning at 7:30. Have a nice time.